Hi, Harry here on Friday, December 1st. I've been watching the markets now for about 50 years, ever since 1972 when I decided to major in business and specifically in accounting and finance. Was I majoring in accounting to be an accountant? No, I wasn't. My father was heavy in politics and worked with a lot of wealthy business owners. So he asked his friends, what should my son major in? And you know what they almost all said? We wish we had taken accounting and finance. You know, most people, successful business people, are in investment or marketing or management or something, but accounting is the language of business, okay? And I never regret taking that. But all this 50 years of watching the markets, you know what the thing I hate the most? The smart money. What they call the smart money. Now, just back up for a minute. How many of you, and I get this, people tell me all the time, how many feel like every time you buy stocks, it seems like you buy and then the markets go down right after you bought it, okay? Or when you sell and you finally sell and capitulate and they turn around and go right up right after you sold. This is not an accident. This is the smart money. That's why I hate these people. Now, 85%, Rodney was telling me, of daily trading is institutional and professional money managers and professional traders who trade for a living. And the problem with these people I have is not that they trade. People will say these sort of trader types keep the markets honest. If they go too far one way, they'll bet against it and vice versa. And that's good except for one thing. They are highly leveraged. If I were in government regulation, the SEC or whatever, I would restrict large traders from trading on high leverage because they are our enemies. We're the 15% of people who are just trying to invest for our retirement or long-term goals, and some of us may trade a little bit or a lot, but these people are our enemy, because that's exactly what they do. They don't trade the markets, they trade you. That's what they do. They watch when people are piling in, and they will jump in and short it when they think everybody's piled in sufficiently, when they see the piling in slow down. They have better information than us and faster information, so they can see this sort of stuff. And vice versa. When there's a sell-off, they'll wait until it looks like capitulation, and then they'll jump in. So that's fine up to a point, because they help keep the markets in balance, and they are the smart money, and they're smarter and all of that. The problem is they can trade on huge leverage. And in futures and everything, stocks and everything, are designed to hedge risk. Somebody can buy a small amount of something to bet against the direction they're in. If you're long and you want to hedge being down, you can buy futures in a smaller amount and hedge your risk if the stock market goes against you sharply, that sort of stuff. So futures are designed for hedging. I would require, certainly with investors over a certain amount of assets, whatever that, be reasonable, not be able to just trade futures short term. Yeah, you can do it longer term to hedge, because that's what they were designed for. But the point is, these people are always working against you. And that's where a lot of the volatility in the markets come. And so you always have to try the best you can. And again, I'm not even the smart money, because I'm not on the floor. I've been on the commodities exchange in Chicago and the New York Stock Exchange. That's where you see these people. I'm not that close up. I'm not that heavy a trader. Yeah, I'm smarter than most people, or I wouldn't be writing financial newsletters. But I would regulate smart money. I would not let people be day trading, highly leveraged futures and stuff like that, unless they were hedging some sort of risk for their business or an institution or something like that. But that's not going to happen. But you just have to think more like these people. You have to think contrary. That's why contrary always pays off investing. Here's the secret of how people think wrongly. Most investors, the longer a stock or a market or an index goes up, the more confidence they have in it. No, you should be getting skeptical, okay? I was just looking at the smart money flow index this morning, okay? That's an indicator you can see. And basically this whole rally since late 2022, they've been increasingly going the other way, betting against it. Now, just short term, they are betting bullish, okay? Not going against everybody else, which means the markets may have this scenario that I'm talking about where we just edge up and make a slight new high in the S&P 500 and the NASDAQ 100, the largest cap indices, which the dumb money flows into, and we may get slight new highs, and they may be betting on that short term, but they have basically been betting against this rally. So you have to look at what they're doing. Smart money flow index is a good thing to check on now and then. I'm going to start featuring this more in the newsletter, and think like the smart money. The longer this rebound from this crash in 2022, which was held off for years by massive stimulus, okay? I mean, we should have topped long-term in stocks in 2007 on the demographic generation cycle. And again, a second time in late 2019-20 on the decennial cycle, okay? And that sort of thing, okay? Think like the smart money. This thing has been going up for a year. It is time to get out, okay? You may miss the last couple percent or so, okay? And there was some famous investor, I forget his name, Rant or something like that, but he said, I always got out a bit early. That was when they asked him the secret to investing. So when it's going one way, get more and more skeptical. And when it's crashing, same thing, get more bullish. Think like the smart money.